Let's get straight to the weaker than expected data out of China, prompting more fears about global growth. Our senior economics reporter, Steve Liesman, joining us with more. Morning, Steve.
Good morning, Sarah. You know, the market's concern over the weak Chinese data shows not just the rise of the Chinese economy as a percent of global GDP, but how much the world relies on China for growth. The weaker November growth numbers, which spooked the markets, they'd be the envy of most developed economies. Retail sales dropped to 8.1% compared to 8.6 in October. We'd give our left arm for those numbers. Industrial production also dropped to 5.4 from 5.9 in October. But now take a look at why that matters to the markets. Here's the share of GDP, 24 for the U.S., 15 for China, but there's the share of growth. China is double the share of global growth as the U.S. is. More telling is that the market pretty much ignoring this morning fairly healthy U.S. retail sales numbers. And the reason you have this a 0.9% increase in the core numbers, and Barclays this morning affirming its view of 2.9% growth in the fourth quarter. In fact, Oxford Economics titles its report Hot Holiday Sales. But the market this morning seems more concerned with chilly Chinese economic data, Carl and Sarah.
I think it's ho-ho hot.
Yeah,
ho, ho, ho,
I didn't know if it was the ho or the hot. I don't know. But anyway, you get the point,
Not
right?
to correct you too much. No, Steve, I just wanted to bring up something that came out of my conversation yesterday with Jim Chanos, noted short seller. Has a new short position on related to all of this trade fight between the U.S. and China. He's shorting the U.S. casinos, Wynn Resorts, Las Vegas Sands. Listen to what he said about that.
Recently, we've added some new and old names. And one area I'm scratching my head about is the Macau casino guys again.
So who are you shorting?
Well, we're basically short the U.S. guys. You would know the names, Wynn,
Las Vegas Sands,
and Sands, and particularly their Hong Kong listed Asian operations. And then we're in our hedge fund, we're actually long the Chinese operators.
He's worried about those permits that are coming due, that the Chinese government basically has the authority to renew or not. I think it's a good example, Steve, when people ask, what's the impact on the U.S. of the trade war? Clearly, China's feeling it. We saw the numbers this morning. But in the U.S., you know, the tariffs are one thing, a little bit of increases of prices, but it shows how vulnerable certain companies that have bet big on China really are in this whole fight.
Well, first of all, I want to make sure that the last thing I want to do is be short a short position of China. So, I mean, he's been on this Chinese short thing for quite a while. And I think what Jim is doing, by the way, is he's underscoring the macro point that I made earlier, which is how much China is a part of the growth story of these companies. And the question I have is the extent to which the administration has taken that into account, and the kind of point that you make, Sarah, which is that there is a knock-on negative effect if that growth story becomes a different story for U.S. companies over there. We do things differently. Instead of making it here and sending it there, we go over there and we make it. We open up a casino over there, or we open up a manufacturing plant over there, and then we bring the profits back home. And there's going to be a knock-on effect. Look, I assume the administration has put all this into the pot and said, okay, we stirred around. It's still better for us to do this, but don't think there won't be knock-on effects, such as the one that Jim Chanos seems to have identified.